Are you a real estate investor or thinking about becoming one? Well, if you answered yes to one of those two questions, then good. You're on your path to building wealth, especially in the environment we are in today with this high inflation, low supply of homes. The trend is your friend. Real estate investing is the best way right now to build wealth, but there are mistakes you need to avoid. Here are the top 4 mistakes to avoid as a real estate investor. All right, the first mistake to avoid as a real estate investor is overpaying. You might say, well, gee, that sounds simple enough, right? Well, there's more to it than just that, all right? Sometimes you might have to pay more than the last person paid for that type of home. That's okay. But you have to have a reason for the price you are paying that's based on logic, that's based on comparable sales. Many real estate investors get in trouble. And this is true if you're a renter or buying a place to rent. This is true if you're buying a place that you're gonna flip. But many people get in trouble as real estate investors because they overestimate what the property will do as a rental. They overestimate what it will do as a flip. They are baking in appreciation or rental growth. If you get that, and you should, that is great. But if you're banking on that, that's when mistakes are made. That's when you hear about, people losing money on deals, or worse, going to foreclosure, when they overestimate the sales price, or when they overestimate what it will happen on a rent. If you overestimate the sales price on a flip, well, you're gonna put in a lot of work, 3 months, 6 months, maybe even a year if it's a bigger flip or a new home, and then you're gonna get to the end, you're gonna be listed too high. Right? What happens when you're listed too high? You don't get offers. Then you lower the price and people think, well, it's been on the market for 60 days. Everything else is selling in 2 weeks. What's up with this house? Something must be wrong, right? That's what the buyer's thinking. And they walk into the house just looking for why it's a bad deal or what's wrong with the house. Then they have to drop it more, right? And they end up chasing the market down. And when that happens, the homes usually sell for less than they would have if they were priced appropriately at the beginning. And what happens? You put in all that work, you put in all that time. You had to pay more in holding costs, taxes, insurance, interest, because it took longer to sell, and you end up not making money, not making enough money, or worse, losing money. So don't overestimate what you could do on a flip, on the sales price. Don't overestimate what you could bring in as a rental. When that happens, you get minimal to no cash flow. Then you're owning an asset that maybe it's going up in value, maybe it's not. You're not making money month to month, right? So you put time, you put money, you put effort into this house, and you're only making a little bit, or maybe you're having to pay money every month, right? Maybe the total expenses, mortgage, debt service, taxes, insurance, maintenance, all that, maybe it's $2,000, you're bringing $1,800 of rent because you overestimated the rent by about 20% or so, which a lot of people do. Now you're having to put in $100, $200 a month, and it still might work out, and eventually the rents might surpass it, but it's not gonna be something that you're gonna wanna repeat. And my experience has been that investors that overestimate on the rental prices don't scale, they don't learn how to do more, because why bother? Like, they put in all this time, effort, money, and they didn't get much in return. Stay tuned for part 2 when I go over the next mistake to avoid as a real estate investor.